Good morning, friends. Okay, let's quickly first close the capital budgeting area. I'll quickly cover the balance three concepts which are pending, do few questions on that, revise it, and then I move to the next segment. So, in capital budgeting, we are still left with decision tree discussion, simulation, and something called as a real option in capital budgeting. Now, decision tree is not something new or different. It is basically used for something called a sequential decision making. What is sequential decision making is when I evaluate a project, I say year one cash flow is 20 lakh. You ask me year two, I give 10 lakh. Year three, 5 lakh. I give one number. Now, suddenly, if you ask me, I say year one, 20 lakh, or it can be 10 lakh, or it can be 5 lakh. If it happens 20, then it can again be 15 lakh, 10 lakh, 2 lakh. Then again it can be. So if I give you multiple answers or multiple options, you will find it very difficult to do it without a diagram. So the diagram is basically called as a decision tree. The diagram helps you in understanding what is happening in the company or what is happening with the project. Just to give an example, I want to calculate the NPV of a project. I want to calculate NPV of a project. So for that, the first thing is to do project, not to do project. If you don't do, the value is 0. If you don't do it, the value is 0. You don't get anything. If you do project, first year can be success, can be failure. First year can be success or failure. If it is success, you can invest 20 lakh, you can invest 10 lakh. If it's failure, you can sell your business for 5 lakh or 3 lakh, something like that. You will keep. If it is 20 lakh, then again it goes further, again it goes further. There are two types of notes which will come when you draw the diagram. There are going to be two types of notes which are going to be there. One is called a decision node and second is called a chance node. A decision node is where you will put a rectangle or a square. A decision node is where you will put a rectangle or a square where you have a choice whether to go up or go down, whether to go up or go down. That is, you can go and say, I will do the project. You can also say that I will not do the project. You can say, I will do the project. You can also say, I will not do the project. So, wherever there is a decision node, the answer for that, every node has to be valued. Every node has to be valued. The answer for that is the higher of the two, higher of the branches which come from that decision node. Once you do, it's a circle here. What a circle is, success or failure is not in your hand. Success or failure is not in your hand. Once you get success, it is a rectangle because you can decide whether you want to put 20 or 10. You can decide whether you want to put 20 or 10. If it's a failure, again maybe it is a box where you can decide whether you want to do 5 or 3. Wherever you can decide, it is a box. Wherever you cannot decide, it is a circle. Wherever it is a circle, the branches need to have probability. The branches need to have probability. Without probability, you cannot proceed ahead. Without probability, you cannot proceed ahead. So there are two types of nodes. One is a decision node, second is a chance node. Decision node, for example, you'll value this. This is 10 and this is 0. Higher of the two is the answer for the rectangle. Higher of the two is the 2, 3, 4, 5, 6. It can be anything. It can be anything. Higher of that is the answer for the rectangle node or a decision node. Chance node is a weighted average of success and failure. Weighted average of success and failure. Moment I say weighted average, I need probability. Moment I say weighted average, I need probability. So you need to attach a probability for success. You need to attach a probability for failure. You cannot attach a probability to do the project, not to do the project. That's your hand. You can do the project. You can decide not to do the project. That's purely your choice. Which choice you want to implement, that's up to you. If you do, it's okay. If you don't do, it's okay. So that's a choice you can take and then proceed ahead. So under a decision tree, I try to make this in a diagrammatic form so that it's easier for me to proceed and analyze it. It's easier for me to proceed and analyze. Decision tree is a diagrammatical representation of the various alternative courses of action. This is useful for sequential decision making. What is sequential decision making is? Let's assume you have to make 5 decisions. Based on the D1 you take, the D2 can change. The question can change. For example, first is to do the project, not to do the project. Not to do, there is no extra decision. To do the project, the next question to use, if you get success, this is the question. If you get failure, this is the question. After getting success, next year if you get success, this is the next question. Next year you get failure. This is the question. So I can keep asking you questions and you will have to keep deciding them. You will have to keep deciding them. Assume you travel to not to do side, then none of the other decision you need to take because you have moved to the not to do. So this makes it easier for me to evaluate a complex problem. See, whenever I also do a question, when I have something very difficult to explain, I normally take the route of a diagram to explain because diagram makes it easier for a person to understand. That is what decision tree is all about. So you will draw the decision tree like this, and valuation you will do it in the reverse order. Valuation you will do it in the reverse order. That is the last node will be valued first. We'll call them as D1, D2, D3, C1, C2, C3. D1 is called decision node, C1 is called chance node. A decision node, a decision tree begins with a decision node. Decision node D1, D2 is denoted by rectangle, is denoted by rectangle. Chance node is denoted by circle. Chance node is denoted by circle. The value of the chance node is the weighted average of the various branches coming out of the chance node, and decision node is the highest of the branches. You can decide whether you want to go to the top, whether you want to go to the bottom. To do all of this, somewhere joint probability is going to be very critical. Joint probability is going to be very critical. We have analyzed joint probability at few other places also. Joint probability is basically happening of two events together. Happening of two events together. So joint probability of event 1 and event 2 happening together is equal to probability of event 1 into probability of event 2. Probability of getting a cash flow of 50,000 in year 1 is 40%. If the cash flow turns out to be 50,000 in year 1, then probability of getting 24,000 in year 2 is 20%. What is the probability of getting cash flow of 24,000 in year 2? Getting cash flow of 24,000 in year 2. Let's understand this properly. Probability of getting cash flow of 50,000 in year 1 is 40%. If the cash flow turns out to be 50,000 in year 1, then the probability of getting 24,000 in year 2 is 20%. Just give me a minute. Just add a word. What is a joint probability? Joint probability. Okay. So if you want 24,000 in year 2 and 50,000 in year 1, you'll have to multiply both the probabilities. You'll have to multiply both the probability. That is 40% is the first year probability, 20% is the second year probability. Put together, you will have a probability of 8%. Let's see this in few questions now. My focus will be more on the diagram there. Hmm. Yes, has to be. No, no, other one will not be a decision. No. Not necessary. Let's see this. A firm has an investment proposal requiring an outlay of 80,000. Investment proposal is expected to have 2 years economic life with no salvage value. In year 1, there's a 0.4 probability that cash inflow will be 50,000. 0.6 probability that cash inflow will be 60,000. Probability assigned to cash flow after tax for the year 2 is as under. If in first year you get 50,000, then it can be 24, 32, 44. If it is 60,000, it can be 40, 50 and 60. There are probabilities attached to year 1. There are probabilities attached to year 2. What NPV will the project yield if the worst outcome is realized? What is the probability of that? What is the best and probability? Will the project be accepted? We will first put this in a diagram form. We'll put this in a diagram. Can I do this without a diagram? This question without a diagram is possible and easy to do also. But some question without diagram will become very difficult to do. So let's put this in a diagram first. First is a rectangle. D1 to do project, not to do project. To do project, not to do project. Not to do get 0. That's all done. Close. Not to do 0. To do project, not to do project. Which is a rectangle? Decision is here. You have already taken the decision. To do project means you have taken the decision of doing the project. Not to do means you have decided not to do the project. So the D1 is a question Or you can say D1 is the question to do project, yes this side, no this side. Yes is on the other top and no is at the bottom. If you decide to do the project, first year how much you can earn? This 50 or 40 is not in your hand. This 50 or 40 is not in your hand. So it becomes a circle. It becomes a circle because it is a chance node. It is a chance node. So you can get 50,000. What is the probability of 50 and 60? 0. 0.4 for 50. If you get 50,000, year 2 again is not in your hand. Year 2 again is not in your hand. What are the values you can get? 24, and if you get 60, what are the probabilities given for each of this? First one in the top, you tell me 0.25. I don't want any discussion beyond this. Wait, 235. Now listen. I have totally 6 branches which are possible. First branch is 50, 24. Second branch is 50, 32. Third branch is 50, 44. That is year 1 can be 50,000. Year 2 can be 24. 50,000, 32,000. 50,000, 44,000. 60,000, 40,000. 60,000, 50,000. 60,000, 60,000. For all these 6, you will have to get 6 different NPV. You will have to get 6 different NPV, and each of them have a probability. What is the probability? Joint. 0.4 into 0.2. 0.4 into 0.2. 8% chance of the branch 1. 8% chance of the option 1. Second one, 0.4 into 0.3, which is 12% chance. 0.4 into 0.5, 20% chance. 0.6 into whatever number. All put together, 100% chance will happen. Which is the lowest cash flow in year 1? Year 1. 50. If 50 happens, which is the lowest in year 2? That is the worst outcome. That is the worst outcome. Anyway, I can solve and get the answer. I'm not discussing I'm not solving the answer. Okay. Which is the highest one in year 1? If you get 60, which is the highest? That is the best outcome. That is the best outcome. Worst outcome is the lowest cash flow. Best outcome is the highest cash flow. This question they have not asked for standard deviation. They can even ask you for standard deviation as well. If you see, I have not drawn a proper diagram here. I've just done, this is not a proper decision tree. This is not a proper decision tree. We are not going to do the answer. Let's just restrict ourselves to the diagram alone. Let's restrict to the diagram alone. In my solution, how it will happen is, here this branch is 6224. What is 6224? Is weighted average of 6 numbers. Weighted average of 6 different NPV which you will calculate. 6 different NPV you have to calculate. Whose weighted average is 6224? Whose weighted averages? What are the NPV you generate? Minus 14, minus 8, plus 17, plus 75, plus 15, plus 24. These are the different NPV we are going to generate. I'm not doing calculation of NPV. Again, I'm repeating. I don't want to get into the NPV calculation. So I get 6 different NPV. Apply the probability on top of it. What is the probability? 0.4 into 0.2, 0.08. 0.4 into 0.3, 0.12. 0.2, 0.24, 0.3, 0.06. So worst is 8% chance. Best is 6% chance. Best is 6% chance. Any doubts on this? Any doubts on this? Let's go to 60 where the diagram will become critical. Go through 60. Without diagram, if you do 60, you will make an error. Okay, L&R Limited wishes to develop a new virus cleaner software. Cost of the pilot project is 2,40,000. So the first decision I need to do is whether to do a pilot project or not. Whether to do a pilot project or not. Let's start. D1 to do pilot project. Not to do. Not to do, you'll get 0. Not to do, you'll get 0. If you do pilot project, what can happen? Success or failure, which is not in your hand. Success or fail. If it was in your hand, then you again put a decision. Okay, again you put a decision. That is, again you will put a rectangle. So here I'm putting a circle. Here I'm putting a circle, and I'm dividing this into two: success, failure with probability. 50-50. If success happens, what is the next thing I can do? Invest or not invest. So that's a decision I have to take. That's a decision I have to take. If I get success, they are saying you can invest a sum of 20 lakh and that will give you 4 lakh every year. That will give you 4 lakh every year. You may say, no, I don't want to invest also. You may say, I don't want to invest. So decision 2, D2. You have a D2 at this stage. D2, where invest, not invest. Invest and not invest is your choice. Wherever it's a decision node, no probabilities are attached. I cannot attach any probability. Failure, the third decision you have to take. You have to take a third decision: invest, not invest. Invest and not invest. Assuming I got success, I have to invest how much? 20 lakh. What is the perpetual income I get? Present value of perpetuity is 4 lakh divided by the discount rate. 40 lakh you earn, 20 lakh you spend. 40 lakh you earn, 20 lakh you spend. Present value of perpetuity 4 lakh divided by the cost of capital. Earn 40 lakh, spend 20 lakh. I go with this branch and I give a value of 20 lakh to this. I give a value of 20 lakh to this because I am ready to do investment. I am ready to do investment. There is a 2 lakh 40 spent. I'll see it later. That is already spent. So we'll see that later. If it becomes a failure, how much you can invest? How much you will get? 1 lakh is translating into 10 lakh present value, negative NPV. Negative NPV. How negative NPV? 1 lakh divided by 10%. 1 lakh divided by 10%, which is 10 lakh. And your income is, sorry, your expense is 12 lakh. Income is 10 lakh. So now invest means minus 2. Not invest means 0. I decide not invest and make 0. I decide not to invest and make 0. If it's a success, I will invest and earn 20 lakh. If it's a failure, I'll stop it. I will stop it. What is the value for this now? Weighted average. Weighted average 20 into 0.5 plus 0 into 0.5, and you have to spend 2 lakh 40 to do this. You have to spend 2 lakh 40 to do the pilot project. You can subtract 2 lakh 40 at both the stages also. That is, in success also you can subtract, failure also you can subtract, or in the end you subtract. Or in the end you subtract. 20 lakh into 0.5, 0 into 0.5 minus 2.4, or subtract 2.4 at D2, D3 in both. That is, D2 if you subtract 2.4 it will become 1760, and D3 if you subtract it will become minus 2.4. Minus 2.4. So net I get here how much? 7 lakh 60, and I decide to do the pilot project. I decide to do the pilot project. Doing the pilot project is more useful. To do test, not to test. Success, failure. Success is invest 20, not to invest. Failure is invest 12, not to invest. And you will have to value now A, B, C, D. Totally 4 notes you have to value. First you have to value D, then you have to value C. Reverse order. Valuation is always in the reverse order. So value of note C is 20 lakh. This is 0. This is a weighted average, and you subtract your cost and you get 7 lakh 60. So net 7 lakh 60 is what makes sense. That is, I'll invest 2 lakh 40. Sorry. Question says no. Pilot project cost. First line. Already incurred. Where it is already incurred. It was already. Then there is no decision to be taken. No. The decision itself is to do that only. No. Whether to spend 2 lakh 40 or not. Our decision itself is to decide whether to do a pilot project or not. If you have already done a pilot project, then it is success, failure. Only analyze that. Not to do is nowhere a choice. No. Any doubts on this? Okay. This is a very good question. May not get tested in exam, the 61, but a very good question to understand the decision tree. It may look very simple when you read the question, This came for 20 marks in exam. This came for 20 marks in exam. Such a lengthy question it is. So I'm not going to solve the full part of it, but I'll explain the diagram. When you do the diagram properly, a lot of things will become clearer to you. So Big Oil is wondering whether to drill oil in Westchester country. The prospects is as follows. If you drill up to 2000 feet, cost is 4 million. You may get oil, you may not get oil. If you get oil, you earn 10 million. You earn 10 million. Then you can also drill up to 4000. There you may get oil, may not get oil. Then you can drill up to 6000. There you may get oil, may not get oil. Question wants us to know what is the successive drilling decision to be done by the Big Oil and how deep should it be prepared to drill. So first thing is whether to drill or not. Okay, that's the first question. If you say yes, understand the flow properly. Okay, first decision is whether to drill or not. That is D1. Answer can be yes, no. No means problem over. Yes means drill up to 2000 feet. Drill up to 2000 feet. You may get oil, you may not get oil. Drill up to 2000 feet. After drilling, it is a circle. Decision you take, you say yes, it is a circle. It's a circle. You say no, no problem. Problem gets over that you are not drilling. If you say yes, you may find oil, you may not find oil. If you don't find oil, next decision, drill up to 4000. Next decision is drill up to 4000. Again, you may find oil, may not find oil. If you find oil, no problem. If you don't find oil, next again you have to take a decision whether to drill up to 6000 feet or not, and then in the reverse order you have to do the valuation. I'll show the diagram first, a rough diagram, and then I show the printed solutions. The first one is D1, to drill, not to drill. Not to drill, no problem, okay. To drill up to 2000. To drill up to 2000. You're drilling only up to 2000 feet. That's the first decision you're taking. Drilling up to 2000. This is a circle because this can have oil found, oil not found. What is the probability of oil finding and not? 0.5, 0.5. If you find oil at 2000 feet, how much you earn and how much you spend? 4 million. So here 6 million is your profit. 6 million is your profit. If I find oil, I'm very happy. If I find oil, 6 million profits I can make. If I don't find oil, so tell me, there's a doubt. Okay, if I don't find oil, then there's a decision. There's a decision to be taken. There's a decision to be taken. What is the decision? Do you want to drill up to 4000 or not to drill? Drill up to 4000, not to drill. If you decide not to drill, you are losing 4 million and it ends there. If you decide not to drill, you have drilled up to 2000, lost 4 million and it ends there. Lost 4 million and ends there. But if you drill, maybe you can make profit. Maybe you can make profit, or you can lose more also. Or you can lose more also. So if you drill up to 4000, again a circle, two things can happen. Oil found, oil not found. If you find oil at this stage, you will earn 5 minus 9. You will earn 5 minus 9, 4 million, whose probability is 0.2. Whose probability is 0.2. Unfortunately, you did not get oil. Then next decision, whether to drill up to 6000 or not to drill. If you decide not to drill, your loss is now 5 million. Your loss is now 5 million. Then again, oil found, oil not found. So this is the successive decision you have to take. D1, to drill up to 2000 feet, not to drill. If you drill up to 2000 feet, oil found, oil not found. Oil not found, headache. Drill up to 4000 feet, not to drill. Wherever you are saying I'm drill up to 2000 feet, I put a circle, because after that, finding oil or not finding oil is not in your hand. Finding oil or not finding oil is not in your hand. But wherever I have this wrote oil found or oil not found, I put a circle, because after that you have to take a decision. After that you have, sorry, I put a rectangle. After that you have to take a decision. Valuation in the reverse order. Reverse order is, for example, if you drill up to 6000 feet, read the question and tell me, and you find oil, what is the profit you make? If you drill up to 6000 feet and find oil, what is the profit? And if you don't find oil, negative 6 million. What is the probability of finding oil? Point. And what is the problem not finding? This circle which you see, or this circle which you see, is the weighted average of 0.25 into 2 into plus 0.75 into minus 6, weighted average of the various branches which come out of it, with probability being the assigned weight. So 0.25 into 2 million plus 0.75 into minus 6 million is how much? 0.25 into 2 plus 0.75 into minus 6, minus. Okay, listen, what happened is, you did not get oil at 4,000. You did not get oil at 4,000 and you decided to put a stop. You decided to put a stop. If you put a stop, what is the loss you have? So listen, in D3, that is oil not found, if you decide to put a stop, your loss is 5 million. And if you decide to continue, your expected loss is 4 million. What is expected losses? It may become a profit of 2 million. It may also become a loss of 6 million. Between minus 4 and minus 5, minus 4 is better. Between minus 4 and minus 5, minus 4 is better. Like this, you'll keep going in the reverse order. D3 will be negative, D2 will also be negative, but D1 will be a positive, which indirectly means you will drill now. First 2,000 you drill. You should hope that you get a oil there. If you get a oil there, you make profit. If you don't get a oil, be mentally prepared that there is going to be only loss in future, but the loss will be lesser as you drill more and more. As you drill more and more, because sometimes suddenly oil may come. Sometimes suddenly oil may come. Worst case scenario, you drilled everything, did not get oil, you will lose maximum money. You will lose maximum money. Able to understand this? It's a very good problem on testing of. In fact, in exam they did not give this probability. They made students to calculate this probability using the concept of conditional probability, which is a very not a very difficult concept, but you would have forgotten what is conditional probability and then trying doing the calculation. So this was a CA final exam question. Maybe in 2007 or 2008 they asked. It was a 20-mark exam question. This is a 20-mark exam question. It may look very simple when I explain the solution, but when you draw the diagram and then do reverse valuation, you will find a lot of time being taken. Any doubts till this? Okay, I have explained decision tree. Now, decision tree can be applied for any situation. Okay, decision tree is not only for this. For example, I am a 10th student. I can secure 60% mark. I can secure 80% mark, or I can secure 90% mark. If I secure 60% mark, I'll do this. If I secure 80% mark, I'll do this. If I secure 100%, 90% mark, I'll do this. Then after this decision is taken, maybe I will start my business. I will get into a profession, or I'll get into employment. If I get into a business, I will invest 10 lakh, I'll invest 20 lakh, I'll invest. So if you tell me a big para like this, and then tell me to understand, I'm gone, because such a big para, so much of item is there. I want to put it in a diagram form. That is what decision tree is all about. Decision tree is only saying whatever data, if you give me a big para, if you see this and understand, it is easier to understand. The same thing was given in a table. Instead of giving in a table, I can give a para saying that you should be prepared to drill up to 2,000 feet. If you drill up to 2,000 feet, this is what will happen. Then this is what. If I give such a lengthy para and tell you to understand the para, it becomes very difficult for anyone to follow the para. Now I can understand. Okay, I will first start. I may get oil in 2,000. I will drill up to 2,000. I will not drill. If I drill, I may find oil. I may not find oil. If I find oil, problem over. If I don't find oil, okay, I may drill up to 4,000. I may decide not to drill. If I drill up to 4,000, I may find oil. I may not find oil. This is a very easy thing to. I have not added the probability because the diagram was becoming very big. I could not add the probability. Ideally, probability will also be added in the diagram itself. In the diagram itself, I can say 0.8, 0.2, whatever the probabilities, I can add that in the diagram itself. So the diagram becomes very easy for a person to understand. That's the only role of decision tree. The role of a decision tree is to simplify the situation, and make it in a diagram form. Diagrams are easy to read. Diagrams and graphs are easy to read. Clear? Any doubts on this? Next comes the next technique, which is called simulation. Now, what is simulation is creation of a real-time scenario. For example, a cricket match is going on. So that is being played in the stadium. I want to simulate exactly the same thing in a cricket game. In a game, I am going to play over my TV in using some game software. I'm going to play a game in my laptop. So that is called as a simulation exercise, where I'm trying to create a real-time scenario. Simulation is basically needed where all other techniques are failing, For example, I ask what is the revenue you will make. You're saying it can be this, it can be this, it can be this, it can be this, it can be this. You are giving some 10 different numbers. Then I ask you what will be your cost price. Again, you give me 10 different numbers. I ask you what will be your selling price. Again, 10 different numbers. Ask you what is the life. Again, 10 numbers. So you give me so many numbers, keep giving this numbers. Now I'm stuck. I don't know what to do. So then I ask, can you attach probability to every number? Can you attach probability to every number without? So for doing simulation, I need two things: range of possible numbers and probability. Range of possible numbers and probability. If you give me that, then I can start doing the simulation. For example, my selling price can be 20, 25, 30, 35, 40. It can be any of this. There is a probability attached to each of this. Probability is 0.1, zero point 0.3, zero point 0.1, zero point 0.4, zero point 0.1. I attach probability and I have given this. Then ask you what is the cost price. Again, you give 5 numbers. I asked you what is the life. Again, you gave 5 numbers. What is the initial investment? You gave 5 numbers. So once you give this number, I will put this data in the form of a random number table. I'll put this data in a form of a random number table. What is random number table is? Start 20, 25, 30, 35, 40. These numbers are there. Probability is there. 0.1, 0.3, 0.1, 0.4, 0.4. I'll calculate something called as cumulative probability. The price can be in the ascending order, price can be in the descending order, price can be in the random order also. Doesn't really matter, but ICI normally follows ascending order. Now you need to put random numbers to this. A random number can be a single digit, can be a double digit, can be a triple digit, can be a 4 digit. It can be anything. Let's assume I take double digit. For double digit, I want this to be in 2 decimals. I want this number to be in 2 decimal. Okay. So what is random number is 0.10, 10, 40, 50, 90 and 100 are the numbers. So random number is equal to 00 to 09. What is 00 to 09 is? 09 is the number before 10. 09 is the number before 10. Then 10 to 39. 39 is the number before 40. 40 to what I should write? Number before 50. 50 to 89. 92. Why number before? Because I stop at 2 digit. Same thing you want to do 3 digits. Add one more decimal. Read this as 100, 400, 500, 900 and 1000. Read this as 100, 400, 500, 900, 1000. What is the number before 100? So 00 to 099, 3 digits. 100, 399. 400 to 500 to 900 to some random numbers we have put some random numbers. Let's take 2 digit. Now I'll be running experiment for 1500 times. I'll run an experiment. So first experiment, I want to know what will be the selling price. I'll do very simple thing. I'll just pick up a random number. Random number is now Excel is picking a random number between 1 to 99. It just picked a random number between 1 to 99. It is like I put the numbers, you pick any number. So 44 came. In the first experiment, selling price will be 30 rupees. Selling price will be 30 rupees between 40 to 49. Between 40 to 49. I want you to run one more experiment. Unfortunately, the formula is such that you change any number, the random number will keep changing here. So second experiment, the random number is 7. 7 is between which one here? 00 to 09. So your selling price will be now 20 rupees. Selling price will be 20 rupees. Like this, you will run thousands of experiment. On selling price, on cost price, on life. Excel can do any number of experiments. Once you are done with all these experiments, you will get 1000 different NPV. Simple average of that is the final NPV. Simple average of that is the final NPV, because I am not having any bias here. I'm running my experiment for 1 lakh times. I can run even for, practically I have done simulation. I have done simulation to find out certain data points. So you can run this experiment for any number of times. You can run this experiment for any number of times. Like this you do it on selling price, like this you do it on cost price, like this you do it on, there are two things. One is something which is not going to change. For example, my initial investment will only be 20 lakh. Don't run any experiment on that. Don't run any experiment. I will not run. Life will be 10 years. Don't run any experiment on that. I will not run it. But discount rate can change. Your cost price can change. Selling price, anything which changes, I need a random number table. I need a random number table. Now, should I do 2 digit, 3 digit, 4 digit? Again, it's random. There's no logic I can add. Random number is anything you can do. You can do a 2 digit one. You can do a 3 digit one. If the probability is in a single decimal, you can do 1 digit also. If it's in 2 decimal, you should do 2 digit random number. If it's 3 decimal, you should. For example, this I could have done even single digit. What is the number before 1? 0. So 0 to 0. It is 0 to 0. What is the number before 4? Number before 4. 3. 1 to 3. Number before 5. So 4 to 4. Number before 9. 5 to 8. And last one is 9 to 9. And here what I'll do is I'll fix a random number between 1 and 9. I want a random number between 1 and 9. You got 1, price is 20 rupees. You got 7, price is 35 rupees. You got 3, price is 25 rupees. You got 7, price is 35 rupees. You got 8, price is 35 rupees. You got 6, price is 35 rupees. Like this, you can keep running any number of experiment. You can keep running any number of experiment. Practically, we do thousands and thousands of experiment. We do thousands and thousands of experiment on each of the parameter which is going to change. On each of the parameter, ICI arranges the price in ascending or descending. Being random number, any order you put doesn't really matter. Any order you put doesn't really matter. But from problem solving, we will arrange the prices in the ascending order and then do it. Any doubts on first the concept? Concept is, you have a situation where you don't know. Now somebody may ask, why don't I do a weighted average of the price, weighted average of it? That is possible. That is ensuring that you get only one NPV. But I want to run experiment for multiple times to check whether what and all can go wrong. After doing so many experiment, I may find how many times I'm getting negative NPV, which may tell me that okay, 20% I may fail also. 20% I may fail also, or 10% I may fail also. Along with doing the simulation, practically we do something called as normal distribution analysis. Whatever NPV is calculated, that is put in a normal distribution graph like this. This is called a normal distribution graph, which will ultimately tell me some probability analysis and helps you, because the objective is to focus on risk. Objective is not to focus on return here. What is focusing on risk? What is the probability of failing? What is the probability of failing? So I'm checking whether I may fail or not. I'm not checking here whether I'm going to pass or not. So the objective is to check. Now simulation says, because you're doing so many experiments and all, you should do your NPV calculation at risk-free rate. You should do your NPV calculation at risk-free rate, because risk is anyway considered in so many experiments, which many authors are not okay with it. Because when you do final NPV and say weighted average or a simple average, you say this is the final NPV. That final NPV unfortunately was calculated at risk-free rate. Unfortunately was calculated at risk-free rate. When I did certainty equivalent factor, I downward revised the cash flow. Cash flow itself was revised downward. Here you don't revise any cash flow down. Whatever cash flow the experiment gives, the same cash flow you continue. Same cash flow you continue. One of the limitation of simulation is doing this calculation at risk-free NPV. At risk-free rate. In fact, not only simulation, CEF approach says you have to do it at risk-free rate. When you do your standard deviation calculation, some question will tell do it at risk-free rate. Do it at risk-free rate, because return is separate analysis, risk is separate analysis. Don't try to combine them. Don't try to combine them together. But logically speaking, NPV should always be calculated only at risky rate. CEF is an exception, because in CEF cash flow is adjusted. CEF is an exception. Simulation is an exercise to imitate a real time problem and arrive at expected results for a large number of experiment. Practically thousands and lakhs of experiment can be done. Final result can be taken as simple average of various experiment. Identify parameters. What is parameter? Items that don't change, and variables, items that change. For each variable, arrange the values in ascending order and calculate cumulative probability. Construct a random number class interval at each variable. Based on a random number and a class interval, select the values. Select the values. NPV, appropriate discount rate, RF, simple average. Simple average. Example. Can you do this example and tell me if random number is 70, what will be the cash flow? If random number is 70, do cumulative probability fit in random number. Do cumulative probability fit random numbers. Please fit random numbers. Write cumulative probability in the side first. Do cumulative probability and fit random numbers. What is the cumulative probability? 0.25, 0.70. What is the random number for this? 002. Why 00? Because 70 is a two digit number. 70 is a two digit number. Next one is 70 is which one? Third one, 30,000. 70 is the third one. So our cash flow is going to be 30,000. I will not be focusing on calculating NPV. I'll only be focusing on understanding this random number table and completing our experiment. Completing the experiment. We need to identify what will change and what will not change. There are certain items which will not change. No random numbers for them. Let's see this in a question now. 62 you will do at home. It's an easier example. Let's do 63. Let's do 63. Just do one thing alone. Just give me a minute. Add cost of project is 1,30,000. That got missed there. Cost of project is 1,30,000. Okay. Now, if you see below, they have given random number 5 digits. That does not mean those are 5 digit. Here you can run a single digit random number experiment, double digit also, triple digit also, 4 digit also, 5 digit also. Normally we prefer double digit. Normally we prefer double digit. How do I take double digit? You can take 53479, any two numbers from there. We normally take it as, so the random number is going to be, because it's random, I cannot give any logic. So the random number I'll pick is 53. From the second one I'll pick 97. From the third one I'll pick 66. Then I'll pick 9. The first two digit. The first two digit. You can pick like this. You can go column wise. You can go row wise. You can go left to right, right to left. You can pick the middle two digit. You can pick the last two digit. You can pick the first two digit. That's your wish, because it's a random experiment. It is a random experiment. You cannot give a logic saying how do you have to proceed. How do you have to proceed? And if ICI question doesn't give proper clarity on the random numbers, answers for every student will change, because you will pick different random number, I'll pick different random number, I'll pick different random number. Only the RN table can match. Only the RN table can match. Let's do the RN table. Random number table. Annual cash flow. Annual cash flow. Value, probability, cumulative probability, and random number. Value, probability, cumulative probability, and random number. $10,000, 15,000, already in ascending order. 20, just put the values, that's all. 0.02, 03. Even if you see 0.30, please write it as, sorry, 0.3, please write it as 0.30. Ensure that everything is two decimal. Everything is two decimal. 0.30, don't write it as 0.3 in exam. Ensure everything is two decimal. Now I have to put a cumulative of this. Now I have to put a cumulative of this. Starting with 0.02, 0.02 plus 0.03 goes on like this. Keep putting the cumulative numbers. Keep adding the cumulative numbers. What's the random number for the first one? Starting with 002, number before 2 is 1. Then 02, 022, 04, 052, 22, 35 to 65 to and 85 to. Somebody says I want to do 3-digit, you can do it, no problem. Just that add a 0 in the probabilities. Add a 0 in the probabilities. Why I do 2-digit normally is probability will be given 2 decimal. If they give you probability for 3 decimal, you cannot do 2-digit random numbers. You cannot do 2-digit random numbers. You will have to move to 3-digit. You will have to move to 3-digit. Any doubts on this? What's the next item which is changing? They have given same thing. Do project life. Project life. 3 to 10 years they have given year. 3 to 10 years. 3 to 10 years. Probabilities are was the random number for the first one? 002, 04, 052, 14, 15 to 45 to 72, 85 to 95 to and 98 to 99. Okay, how to pick random number? I cannot give any logic to it. It's your wish how you want to do. It's your wish how you want to do. You may start with, I think ICI has done 53 is the first number picked. 53 is for cash flow. Tell me 53 is the number, what is the cash flow? Look at your table. If 53 is the random number, what is the cash flow? So first experiment 30,000 is the cash flow. First experiment 30,000 is the cash flow. Second number 97, what is the life? Again I'm repeating, see I need two numbers, one for the cash flow, second for the life. For life, for cash flow I said 53, for life I am saying 97. This is one experiment, okay? This is one experiment. 30,000 into the annuity factor for 9 years minus the cost of project, minus the cost. Second experiment, 66 is the random number. What is the cash flow? 66. 99 is the random number for life. Third experiment, 30, 81, 19, 09. So like this you can keep going on. You can keep going on. You can keep running any number of experiment you want. You can keep running any number of experiment you want. For random number we can begin from anywhere. From anywhere, taking at random from the table. This is what ICA has exactly done. Okay, these are exact ICA wording. You can take anywhere and read any pair of adjacent column or row wise. You can do column wise. You can do row wise. For the first simulation we need 2-digit random number. For annual cash flow and project life, the numbers are 53 and 97. You started in this order. 53 you picked it from there, 97, 66, 99, 30, 81, 19, 09, 31, 67, 81, 70, 38, 75. Like this you can keep running experiment. Somebody says no, I want to go this way, do it. Somebody wants to say I want to do reverse, do it. There's no logic, nothing here. That is why why will answers remain same? For example, if you run lakhs and lakhs of experiment, no, whether you run or I run, answer is going to remain same, because so many experiments have been done, so many experiments are done. So that average, when you do an average of 1 lakh numbers, my answer and your answer will almost match. But when you do it only for 5 variables or 5 times 10 times, and all is of no use. So the objective to introduce this is to you explain the concept. You cannot do the full simulation and all, you cannot do full simulation. Clear? Any doubts on this? You can take anything. They wanted you to do 10 experiments. So the use cases I'm saying, no, I got into a situation where I wanted to, for example, we had a scenario where we were taking a loan, we were to analyze the default possibility of a loan. So the client may default in future or not. I was in a credit rating industry. So we were evaluating what kind of cash flows that company is going to generate and attach probabilities to it, and did simulation analysis. When we did simulation analysis, in some situation default will happen, some situation default will not happen. In a credit rating industry, based on your probability of default, a rating gets assigned, a AAA rating or a AA rating or a category rating. So we wanted to know what is the probability of default by doing a simulation analysis. So that is what was presented. I think the experiment ran for around 1 lakh times. 1 lakh times. Excel will automatically run it. There's nothing needs to be done. Once you decide one experiment properly and put formula, everything else automatically Excel will take care. So that's not a bigger thing. Just you need to model it properly in Excel, and automatically 1 lakh, you can even do any number, not even 1 lakh, you can even do it infinite times. Clear? So now at the end you have got a result, you have, then I can say this company deserves a rating of maybe triple B. Then you decide whether you, it will give you, it gave me, that's not the only way, that was one approach I wanted to follow. So that is why we run so many experiments. No, the purpose of doing so many experiments is to know. When you run so many experiments, for example, see, when you go in a cricket match, the player may score 0, the player may score 10, the player may score 20. The random experiment is trying to give all possible scores he is going to get, and somewhere I tell finally this is what is going to happen. Now you may say that the skills change, all that change. I cannot factor all that in the calculation, but that is factored in my cash flows itself. That is factored in my cash flows itself, saying that this project can generate so much. At home, do try this question where there is a random for demand, there's a random number for CFAT, and there's also a random number for likely investment. To make it simpler, the random numbers are properly given here. The random numbers are given here, so you need not get into. Also in exam, mostly they will give like this. They will give it like this, because otherwise every person will run different experiment. Every person will run different experiment. Answer will not match. So they will give you the random number. If you do with this random number, every student answer is going to be same. Every student answer is going to be same. Clear? Any doubts on simulation? Last part, where ICI has added something called as option in capital budgeting, which is called real option in capital budgeting. I'll first set the context of it. I'm not going to solve any question because there's no practical question in ICI material, but this is discussed again in derivatives. In derivatives, there's an option valuation which comes where we'll follow something called as a Black-Scholes model of valuation. So there you will be doing this again. That is real option valuation. There's something. Hello. Sorry, yeah, tell me.
Sorry, sir. Before this, that random number table last column is there. No, how to start with that? Like you will start with 0 0 to 0 1.
Sorry, which number? Yeah, you should start with 0 0. Start is 0 0.
Hello.
Start is 0 0, friend. Hello.
0. That interval, how to fix it, sir?
What interval to fix? 0 0 is the starting.
Sir, 0 0 0. And in the next row, then 5 14 and 15. 14,
so number before 15 is what? Number before 5 is what?
4.
What? 4. So 0 0 to 0 4. Number before 15.
Sir, no, sir. 15 to 44 we are taking, no.
You asked me outside.
In the second row, the delta is 9.
No, friend, you asked me outside the class. I'll clarify. I think you're not getting it. So just ask me outside the class. It may not be of much addition to others. Okay, option in capital budgeting. So sometimes what can happen is I want to do a project today. The project is not a good one. It is going to generate negative NPV for me. It is going to generate negative NPV for me. For example, Reliance, when they wanted to introduce Reliance Jio, they said for the first year, let's spend 500 crore rupees and make loss. Let's spend 500 crore and make loss. I did NPV analysis. First year alone, if I do analysis, first year if I do analysis, and I may get to know that the project is a failure. But at the end of 1 year, I'm going to take one important decision. What the decision is, I may decide to expand or I may decide to close down. I may decide to expand or I may decide to close down. If you decide to close down, entire 500 is gone. That's a problem for you. But you may decide to expand also. That is an option given to you. That's a option given to you which you may exercise depending on how the business is doing. If Reliance Jio, when they introduced, if the response was bad, maybe they would have closed it down. But the response was very good, so they expanded their operation. They expanded their operation. So there can be an option to expand. There can be an option to abandon. Abandon is closing down a business. Abandon is closing down a business. Option to expand is technically like a call option. Option to abandon is technically like a put option. I'll discuss that part of it when I go to your derivatives. When I go to derivative, simple logic here is, sorry, can you please be on mute? Simple logic we are trying to do here
So
is,
voice is breaking.
sorry, yeah, friends. Okay, so I may decide to expand in future, or I may decide to abandon the project in future. But to do all that, first you need to do the initial investment. First you need to do the initial investment. It is like you construct a building. The base project is the foundation. Without doing the foundation, you cannot construct the first floor. You cannot construct the first floor. First floor is an option which you may do, may not do, which you may do or may not do. Foundation on a standalone basis is a bad project. Foundation on a standalone basis is a bad project. But because of the foundation you created, you are able to do one more project. You are able to do one more project which is giving you money, which is giving you money. What capital budgeting is saying is, please evaluate them together. Please evaluate them together. I'll give you an example. ABC is evaluating a new piece of equipment that will automatically install power windows in cars coming off the production line. The equipment will cost 35 lakh, and the firm estimates that the present value of the savings from installing the equipment is 28. That is, I will spend 35 lakh on the equipment and I'll save how much? 28 lakh. So I lose how much? 7 lakh. I'm thinking of whether to install this equipment. I gave this information. You said don't do it. You said don't do it because 7 lakh loss is there. 7 lakh loss. Then they're saying production manager is also considering purchasing a module that will allow the equipment to be used for company's SUV production. He is also thinking of purchasing a module that will allow the equipment to be used for company's SUV production. If you want to buy the module, first buy the equipment. If you want to buy the module, first buy the equipment. Equipment you are saying you don't want to do it. Equipment you are saying you don't want to do it. Why are you saying you don't want to do? Because it is having negative NPV. But if you buy this module, the module is a real option. Module is a real option which will give you how much? Cost of 11 lakh, but will save you how much? 20 lakh. So the module has a NPV of 9 lakh. Module has a NPV of 9 lakh. Our module has a value of 9 lakh. Module has a value of 9 lakh. In this example, base project, base NPV is negative 7. Base NPV is negative 7. Value of the project is 9 lakh. Value of the project is, or value of the option is 9 lakh, and overall NPV is 2 lakh. Overall NPV is 2 lakh. So what is the NPV of the project before? Before is negative 7. After, another 9 lakh added, 2 lakh. In this I can attach probability. What I can attach probability is negative 7 is okay. This real option is there. But there's only a 60% chance that you will buy the module. There's only a 60% chance. If there's only a 60% chance, I can earn only 60% of 9 lakh. I can earn only 60% of 9 lakh, which is 5 lakh 40. My base NPV is higher. I don't want to do. I don't want to do both. I don't want to do both. I don't have a choice of only doing the module. I don't have a choice of only doing the module. I'll have to do both or reject both. Or reject both. Or I can even do only one. Only one is only foundation. Only foundation. If option is bad, let's assume the option they say you have to spend 25 lakh and you'll get 20 lakh. I'll say I don't want to do option. I let me do only the foundation and end it. Let me do only the foundation. So in material, you have certain examples. These are good problems, not much to solve. There will be a base NPV and then there will be some data on the expansion. Some data on the expansion. Do give it a try at home. You'll understand them better. There's a base option and there's a value of the option to expand. There's a value of option to expand. I'm kind of done with the entire capital budgeting part. I will quickly summarize them. The entire capital budgeting part. I have gone this little bit slow than my usual speed. So this is little bit on the slower side. I in fact wanted capital budgeting to get over yesterday itself. It didn't get over. Okay, let's quickly summarize them. First thing is basics of capital budgeting, where we have 6 techniques of capital budgeting: payback, discounted payback, NPV, profitability index, ARR on average investment, ARR on initial investment, and IRR. IRR can have a modified IRR as well. What is payback is? Payback refers to the number of years in which you recover your initial investment without considering time value of money. Without considering time value of money. Year, cash flow, cumulative cash flow. You start with a negative value and you keep writing base year plus unrecovered cash flow of base year divided by cash flow of next year. Discounted payback, same calculation, but you have to consider time value of money. Year, cash flow, PVF, DCF, CDCF. Cumulative DCF you will have to look. The last year in which cumulative DCF is negative is called base year. Base year plus unrecovered discounted cash flow of base year divided by discounted cash flow of next year. Third technique is NPV, most commonly used one. NPV is present value of inflow minus present value of outflow. Payback, lower the better. Discounted payback, lower the better. NPV positive is better. NPV positive is better. Profitability index or benefit cost ratio or present value index or desirability factor is the ratio of benefits to cost. Benefits is present value of inflow, cost is present value of outflow. Anything greater than 1 is better. Greater than 1 or greater than 100%. It can be expressed in times, it can be expressed in percentage. If you have NPV in the question and outflow in the question, you can combine them together and get the inflow and calculate the profitability index. Accounting rate of return is the ratio of average profit to the initial investment or average investment. Average profit is equal to sum of all profits divided by the number of years. Initial investment is initial outflow. Average is initial plus salvage value divided by 2. IRR is the rate of return at which NPV of the project is 0. If you are generating positive NPV, IRR is greater than discount rate. If you are generating negative, IRR is less than discount rate. And if you are generating 0, IRR is equal to discount rate. In order to do this, I need one positive NPV and one negative NPV, for which I need a guess rate. Guess rate is technically equal to 2 by 3. 2 by 3 of ARR on average investment. 2 by 3 of ARR on average investment. Moment you get one positive, one negative, L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1R. There's a shortcut approach when you have one inflow, one outflow. Future value is equal to present value into 1 plus R the whole power N. What discount rate do I use for project evaluation? I'll have to use the cost of capital normally. If there is anything specific given to the project, please use specific given to the project. Also, what can happen is there can be revision in cost of capital. There can be a revision in cost of capital. If there is a revision, then PVF of year 2 is equal to PVF of year 1 divided by 1 plus the new discount rate. Rules for computation of cash flow. Depreciation is a non-cash item. Please ignore it, but consider the tax benefit on depreciation. How is it considered? It is auto considered when you deduct depreciation and add back depreciation. When you deduct and add back. Opportunity cost is the cost of the benefit foregone. If you have pre-tax opportunity cost, deduct before PBT. If you have post-tax opportunity cost, deduct after PAT. Deduct after PAT. Sunk cost is something which is already incurred. You can ignore it in your analysis. Overheads, apportion, general, corporate is ignored. Specific or incremental is considered in the calculation. Working capital, increase in working capital is an outflow, decrease in working capital is an inflow. You'll have to ensure that you do this calculation of. We were doing this analysis even when I did corporate valuation. Corporate valuation also we did some adjustments on working capital front. Reward exclusion principle says whoever you are evaluating, if you're evaluating for FCFF, ignore the reward paid to debt, equity, and preference. If you're doing FCFE, ignore the reward paid only to equity shareholders. Incremental principle is consider only the incremental revenue or incremental cost in your analysis when you're evaluating with the original scenario. Simple rule for finding a relevant item is doing yes or no analysis. What is yes or no analysis? Is you will check an item and see if you do the project what happens, if you don't do the project what happens. If there is a difference in the answer, it is a relevant cost. If there's no difference in the answer, it is not a relevant cost. Steps in calculation of cash flow. I have initial outflow, which is capital expenditure, working capital. Apart from this, I can have some compensation paid, I can have some installation charges, I can have a subsidy, I can have a government grant. All that can come into my initial outflow. In between flow is equal to incremental revenue, incremental cost saving, all cost other than depreciation, PBDT, deduct depreciation, PBT, deduct tax, VAT, add back depreciation, CFAT, and three items: increase or decrease in working capital. Increase in working capital is outflow, decrease in working capital is inflow. Payment for original machine. If you have not paid fully, now make the payment. Purchase of additional machine, and sorry, add back depreciation. Sorry, yeah, only these two items will come. Then terminal flow is equal to net salvage value, recapture of working capital. Net salvage value is comparing sale value with book value, which can lead to capital gain or capital loss. There can be a tax paid or tax saved, and you leave a line and write net salvage value. An organization has zero sale value, but it can have NSV. It can have NSV because of capital gain or capital loss. And in case sale value and book value same, in case sale value and book value same, NSV is equal to sale value. NSV is equal to, if question says tax on capital gain is ignored, directly you can write it. Consolidate them together. Year 0 will come from step 1, 1, 2, 3, 4 will come from step 2, and last year will come step 2 plus step 3. Mostly will calculate NPV. Mostly will calculate NPV. If you are following block of assets method, no capital gain, capital loss unless the block is fully exhausted or the value is fully exhausted, and depreciation will be charged on opening block value. Add the block value because of addition, deduct because of sale, and on that amount you will charge depreciation. If you buy any asset at the beginning of the year, capital budgeting assumes it will happen only at the end of the year. Any asset at the beginning of the year will have to be written in the previous year. Impact of losses. Losses can save income tax for a company in case you have adequate profits in other businesses. So any loss will lead to immediate tax saving if you have profits, will lead to deferred tax saving in case question says carry forward and set off, and last scenario where you have no carry forward, no set off. Tax exemption. If there's a tax exemption for a specific percentage of profit, my effective tax rate goes down. Effective tax rate is equal to normal tax rate into 1 minus the exemption percentage. Expenses not paid in the year of incurrence. If you don't pay some of the expenses in the year of the incurrence, it will become a current liability and will be reflected as decrease in working capital. Will be reflected as decrease in working capital. Treatment of subsidy or government grant. If you get any subsidy or a government grant, you can split them into capital grant or revenue grant. Capital grant may be adjusted with the cost of the asset, may not be adjusted with the cost of the asset. If it's adjusted with the cost of the asset, lower depreciation. If it's not adjusted with the cost of the asset, no lower depreciation. Revenue grant can be taxable, can be exempt. If it's taxable, right before PBT. If it's exempt, right after your PAT is calculated. Utility value, weighted average of the various possible utility value with probability being the assigned weight. Select a project which has higher utility value. FCFF versus FCFE approach. FCFF approach basically says ignore the reward paid to debt, equity, and preference. FCFE says ignore the reward paid only to equity guy. FCFF approach is discounted at KO to get project NPV, project IRR. This is discounted at KE to get project IRR or equity equity NPV and equity IRR. Adjusted present value approach basically says first evaluate the project without bringing the debt equity mix. Assume it's fully equity funded. Calculate base NPV. When you do base NPV, no issue cost, nothing needs to be brought in. Base NPV is present value of future cash flows discounted at unlevered cost of equity. Unlevered cost of equity. Then bring the tax angle. Debt has tax benefit. There are two benefits. One is tax benefit. Second is lower interest. Lower interest. Factor that and deduct something called as issue cost. Deduct something called as issue cost. EAB or EAC approach can come into picture when you are going to repeat something continuously and the life of the two projects are different. EAB is equal to NPV divided by annuity factor. EAC is equal to present value of outflow divided by the annuity factor. Abandonment decision is deciding whether to give up my existing car or not. Technically, there is no outflow, but opportunity cost. What is opportunity cost? NSV of the car today and working capital block today. You do your in-between flow in the normal manner. Terminal flow is NSV of the car again. NSV of the car again at the end of life. Recapture of working capital. NPV positive, continue with the car. NPV negative, please sell it. Please sell it. Then comes the replacement, which is combination of new purchase and new purchase and abandonment. That is, you are going to buy a new asset in place of an existing asset. Buy a new asset in place of an existing asset, which is called replacement decision. Three types of problem. One, pure replacement question, where you analyze old separately, new separately, do incremental. In when you do old analysis, you have to consider net salvage value in step one. You can do old minus new in a single working note also. You can do it as separate columns also. That's your wish, depending on the comfort on your question. If you're doing it in a single column, then you'll say sale value, purchase price of the new machine is outflow, sale value of the old machine is inflow. If you do it separate, new minus old, both will be negative. Minus of minus will become positive in the calculation. Minus of minus will become positive in the calculation. Second is deciding what is the optimum life of a machine. Deciding what is the optimum life of the machine, whether you have already purchased it or you're going to buy it in future. So if you have already purchased it, you're not analyzing for that machine. You're analyzing for some other machine. You're analyzing for some other machine, because I'm going to continue. I'm part of company Ola. I'll be continuously buying cars. I'll be continuously buying cars. So I keep buying cars every year. I keep buying 100 cars. Now with this 100 cars, what is the right life? 2 years, 3 years, 4 years is what I'm deciding. To do that, you will have to calculate buy use for 1 year, buy use for 2 year, buy use for 3 year, buy use for 4 year. In this calculation, you can follow NPV approach. You can follow PV of outflow approach. NPV if inflows are given. PV of outflow if only outflows are given. So whatever number you get, if you get NPV, divide by the PVAF, you'll get EAB, or divide by EAC. Third is when should I replace? When should I replace? For doing when should I replace, if I have very limited option, that is today and 1 year, do the cash flow properly. That is, if you replace today, what happens? If you replace a year later, what happens? Life is going to be different. Go with EAB or EAC. But where you have multiple options and life is longer years, then you calculate the EAC of the new machine first. EAC of the new machine first, and then say old machine for 0 year, new machine for 4 years. So you sell old machine for 1 year, new machine for 3 years, old machine for 2 years, new machine for 2 years. So that's an approach we can follow. So three types of question: evaluating the replacement of an existing machine with a new one, determining the optimum life of an asset yet to be purchased or purchased also, and when to replace an existing asset. Inflation and capital budgeting, there are two types of cash flow. One is nominal cash flow and second is real cash flow. Nominal cash flow is also called as money cash flow, which includes inflation. Real cash flow excludes inflation. Nominal discount rate includes inflation. Real discount rate excludes inflation. Real cash flow plus the inflation percentage is nominal cash flow. Nominal cash flow divided by 1 plus inflation rate is the real cash flow. So you can move from here to there, from there to here. 1 plus money discount rate is equal to 1 plus real discount rate into 1 plus inflation. I don't remember a formula. Logic is money discount rate is RDR plus inflation. You cannot add percentage, so you add a 1 and then do multiplication. Expected value is the weighted average of the various possible value with probability being the assigned weight. In approach 1, which is used in two situations, NPV directly given, or they ask you best case and worst case. NPV, probability, product, deviation, PD square. Sum of product is the expected NPV, square root of PD square is the standard deviation. In some question, they don't even ask NPV, they give cash flow. Then cash flow, probability, product, deviation, PD square. No multiple years, only 1 year. Only 1 year. Then you have something called as coefficient of variation, which is risk per unit of return. Risk is standard deviation, return can be NPV or only cash flow. There are problems where only cash flows are given. Second type of a question, which is what we will do in most of the problem, where cash flows are given with probability. The cash flows can be every year, or cash flow can be only once they would have given, and same will get repeated. First thing is you'll have to calculate the expected cash flow and standard deviation for every year. How you do? Cash flow, probability, product, deviation, and PD square. Sum of the product is year 1. If the same gets repeated, same for year 2. Same gets repeated, same for year 3. Same gets repeated, same for year 4. And your standard deviation will also be same. Based on the expected cash flow, you calculate an NPV, that's called expected NPV. That is called expected NPV. And based on the standard deviation, you do year, standard deviation, PVF, discounted standard deviation, DSD square. DSD is the total of NPV, standard deviation if the cash flows are dependent, and square root of DSD square is the standard deviation if cash flows are independent. Independent is less risky, dependent is more risky. Dependent and independent scenario. If you want probability for a dependent NPV, if probability for a dependent cash flow is equal to probability of year 1, Independent is probability of year 1 into year 2 into year 3 into year 4 into year 5. So we end up doing power number of years. Power number of years. RADR is basically saying if you have a risky cash flow, discount it at a higher rate. If you have a less risky cash flow, discount it at a lower rate. So RADR is equal to risk-free rate plus risk premium, or you can apply a formula called RF plus risk index into normal rate minus the risk-free rate, or you can calculate based on coefficient of variation or based on standard deviation. Certainty equivalent factor basically says I want to give confidence to the given cash flow, so I'll convert the uncertain cash flow into certain cash flow by multiplying with certainty equivalent factor. So uncertain cash flow is given in the question. Certain cash flow is equal to uncertain cash flow into the CF. Uncertain cash flow into the CF. You'll have to discount this at risk-free rate of return. High CF indicates low risk, low RADR. Low CF indicates high risk, high RADR. That's the link between the two. Sensitivity analysis and scenario analysis. Sensitivity analysis, one change at a time. Scenario analysis, multiple changes at a time. For sensitivity analysis, we have two approaches. One, assume uniform adverse change in each of the variable and find out the impact on NPV. Higher the impact on NPV, more is the sensitivity factor. Second approach is finding out cushion percentage. Finding out cushion percentage, that is how much cushion is available in my input parameter. How much cushion is available in my input parameter. How do I calculate the cushion available? I found out at what will be the zero NPV change by base into 100. How much should be the change? What is the base into 100? Lower the cushion percentage, more problematic is that factor. Scenario analysis, you consider multiple changes at a time and then do it. Then today we started with decision tree. Decision tree is diagrammatic representation of various decisions to be taken. Start with a decision node, which is a rectangle, can be broken down into two circle, can be even broken down into two. Again, if you take further decision, circle can again become rectangle, rectangle can become circle. Whenever you are putting a rectangle, the two branches will not have probability. Wherever you put a circle, the branches need to have probability. The branches need to have, if branches are not having a probability, it means it is not a circle, it is a decision. It is a decision. So value of a decision node is the higher of the value, highest of the value of the branches coming out of it, and value of a chance node is the weighted average of the various possible value with probability being the assigned weight. Simulation is converting a real-time problem into an imitating a real-time problem in form of a financial model where you will be given various cash flows, various profits, various data on life. You have the probability, put a total called as cumulative probability and then fit in random number. You have your random number which can be given in the question, R in table is given, or they may tell you in exam that you put any random number. It can also be saying that you can put in your own random number. So I put some random number, I look at where does it fit in, I get the cash flow, I get the life, I get the price, I get the cost, and then do the NPV. Highest NPV I'll get, I'll get multiple NPV, take a simple average of that, take a simple average. And last one is option in capital budgeting, where you have a foundation project which is bad and there's a new project which could be good, So I don't want to do the foundation project because it's bad, but the better project is there. So you first analyze the base project, then you analyze the option, club them together. Clubbing them together, if the project is viable, go ahead and do the project. Clear? Any doubts on this? Okay, let's take a break of 10 minutes and then resume.